Fellow risk takers, this is your worst. Podcast host Andrew Stotz from A Stotz Academy, continuing my discussion with Larry Swedroe, who for 3 decades was head of research at Buckingham Wealth Partners. You can learn more about his story in episode 645. Larry stands out to me because he bridges both the academic research world and practical investing. Today, we're diving into a chapter from his recent book, Enrich Your Future, The Keys to Successful Investing. Specifically, we're going to be going over chapter 19. Is gold a safe haven asset? Larry, take it away.
Yeah. So I think the best place to begin this story is reason that I hear the most. There are generally two reasons people want gold in their portfolios, at least want to consider it. I think we probably could agree the most common one is it's a good inflation hedge. Okay. Well, unfortunately, that's only true if your horizon is about a century long. And I don't know anyone who has an horizon of a century, although the Yale endowment might have one of that long. No individual does. Even at 10 years, the research shows that gold is not a good inflation hedge at that horizon. The best hedge against inflation, of course, is to own, at least in the U.S., U.S. investors who own an inflation-linked bond. In the U.S., they're called TIPS. There are other countries that also offer inflation-linked bonds, and that gives you perfect hedge against it, against inflation. But if someone doesn't believe that evidence, this is the empirical research, here's a specific story that I think should convince anyone you should not buy gold because you think it's a good inflation hedge. So in 1980, gold hit a high at that time of $850 an ounce. 23 years later, it was something like 270, and inflation averaged 4% a year for that 23-year period, roughly. So that meant that gold lost 86% of its real value during that period. If something's a hedge, it should lose zero. So anyone who claims gold is a good inflation hedge over any normal investment horizon is just simply wrong. So that's number one. Over a long horizon, it is true. And the great example is this. If you go back to the time when Jesus walked the earth, a Roman centurion could buy a good suit of clothes armor for about a price of an ounce of gold. Today, an ounce of gold is about, I think, $2,500, something like that. And could buy you a nice Armani suit and tie and, shirt and shoes. And so you got that. So
Your business
it
armor.
gave you the hedge. It gave you the hedge, but you had a zero return for 2,000 years. So to me, that's a pretty lousy investment. Okay. Now, that doesn't mean that gold may not play a role in its second uh, reason that people consider it, and that's as a safe haven against bad geopolitical risk. People could think of Nazi Germany, for example, or Cambodia or Russia or China or these kinds of places, especially India and China. People there poured gold for those types of very reasons. Uh, One of the things that I point out before getting to the research on that is keep in mind that, for example, the Jews in Germany who had gold, the Nazis came with machine guns and took their gold. So unless you have the gold stored someplace where you could leave and get to it, it's not going to do you any good. Maybe nice as jewelry you're wearing it, but it won't serve for the reason that lots of people, actually do buy it. With that said, here's some more evidence that gold serves as a safe haven sometimes but nowhere near as often as people think. There, in the periods when the stock market goes down, okay, it's about 17% of the months when the market goes down, gold goes up. So that's good. Sorry, 17% of the time when the market is down, gold also goes down.
Mm.
19% of the time when the markets go down, gold goes up. So it's close to a 50-50 coin flip, whether gold will act as a hedge when the stock market is going down. So that doesn't look to me like a very good hedge, especially when 2/3 of the months the markets are going up. And so you're not gaining much of an advantage when it's going down. Having said that, there are other periods when geopolitical risks show up and gold does well. So I don't have a problem with people allocating a very small amount to their portfolio, but they should only do it if they're prepared to earn lousy returns most of the time, like 23 years. And then when the risks do show up and governments become profligate and spend too much money, you get spectacular returns, for a short period of time, right? But the only way you earn those returns if you're able to stay the course, and I don't know too many investors who are able to wait out 20 or longer year periods and not only stay the course but rebalance. So that's a real problem. I would tell my advice was never, you shouldn't have probably owned more than 5% of your portfolio as gold. But if you really feel that you need a hedge against geopolitical risks, you know, that's okay. But you have to remember today, gold is an opportunity cost of almost 5% because that's the riskless rate in T-bills. And if you own an ETF, a convenient way, that might cost you another 30 basis points or whatever. So 5.25%. So gold has to go up, 5.25% a year for you to be even, right? And
Mm.
gold is also not taxed that efficiently. It's taxed as a combination, at least in the US, somewhere between capital gains and ordinary income. It's treated as a commodity. So that's my thinking, on gold. It does act as a safe haven on occasion,
Hmm.
but there are also many times when it doesn't, and it actually doesn't even hold up. It actually goes down, and it's a 50-50 coin toss historically, slightly favoring gold. When the equity markets go down, the gold will also go down. And one reason is markets often go down when the Fed tightens monetary policy, and that means the cost of owning gold is going up because you're giving up that carry, giving away the interest income you're going. And tightening Fed means likely less inflation risk, so gold goes down as well. So
So,
that's my thoughts on gold.
so inflation hedge you talked about, and it's not really an inflation hedge. And if you run an inflation hedge,
Except
you
at
get
at very long horizons.
right.
I would
And
say a minimum of like 25, 30 years.
but if inflation is your worry, then tips is a better
Much better.
tool.
Not even close.
Yep. Okay. And
Tips
then
is a perfect hedge.
okay.
It moves exactly with at least the reported CPI. Your inflation rate may be higher or lower than the consumer index, depending upon what your mix of spending is. But it's a perfect hedge against the reported inflation.
And gold as a safe haven in the case of geopolitical events and stuff, occasionally, and but not always for sure. And then the other one is currency. For a lot of people, they look at the US dollar and they think at some point this currency is going to collapse, and I don't know where to put my money. Do I put it in Chinese? Do I put it in euro? Do I put it in, where do I put that? And so some people say, oh, well, I think I'm going to use gold as a hedge against the US dollar collapsing.
The evidence shows over the long term, gold is not a good hedge against currency risk. It's it can be a good hedge, as we've said, over the long term against inflation. And the only reason the dollar should collapse is if you get high inflation. So I'd rather own tips than own gold. All right.
Okay, so
Uh,
tips pretty much does the main thing that most people are thinking about when they go into
and you
gold.
get a real rate of return today guaranteed of about 2%, right? Instead of no real expected return for gold over the long term. It's been zero for 2,000 years.
So let's imagine now. I do a lot of correlation analysis, just like for fun, like looking at 3-year rolling correlations of different asset classes or different ETFs or whatever relative to, let's say, the S&P 500 as an example. And the problem that so when I'm thinking about it, I'm thinking about obviously I don't want to damage my returns too much, but I'd like to find something that has a low or negative correlation. If you do something like, let's say, take REITs as an example, or commodities funds, which may include gold, what you find is that generally these things are highly correlated to the market most of the time. So although they may have some good returns, they're not really a diversifying asset. Then when you look at gold, you see that, well, the correlation is zero. Yeah, I would like to have negative, but I definitely don't want to have like highly correlated, or else I just hold that in the S&P 500. So, but I also know that, okay, the cost of having zero correlation is, it is going to lower my overall portfolio uh,
Likely.
volatility by a small amount, but it's also going to damage the return. So I would say that, lower correlation is in theory better, but if it damages your return,
You
then
have to think of that as the cost of insurance against inflation risk or geopolitical risk. Up until 2020 or right through 2022 even, you know, uh, the carrying cost of gold was zero. The Fed had the interest rates, in my opinion, extremely foolishly, and eventually created all kinds of problems, bubbles in asset prices and stuff. But the carrying cost of gold was zero.
Mhm.
So fine, you want to own gold, it's not costing you anything in terms of carrying costs. Today, that's not true, right? What I'm using what I think is a better, protection against inflation risk is owning private credit that's senior secured and sponsored by, high quality private equity firms. The average loan to value is about 40% in the fund that I'm in, and
Mm.
the yield is 11 and a half, and it's all floating rate. And the historical default losses are under 1%. So I'm getting 11.5% and have inflation. But now I am taking some economic cycle risk because you get a soft recession, right?
And and
Uh,
and before,
but that's a big price. That's a huge premium, right?
mm,
Over, say, T-bills, which are 5. So I'm getting 6.5%, which is an equity-like return historically, with literally about 1/5 of the downside risk, or even less than that, of equities. So to me, that's a superior way, especially if you take the allocation from stocks, because now you've lowered the overall risk of the portfolio, right? Because, they're like 20% or less risky than stocks. And yet you got that kind of return. If you take the allocation to gold from equities, now you're really lowering the expected return of the portfolio.
and what about the role of bonds? If you take a general, let's say a bond ETF, let's just say government bonds, let's forget about credit risk and things like that, and take a Vanguard type of ETF of bonds, what you're going to find is the correlations are even lower than gold. So over
No,
time,
that's not true.
what are the correlations between?
Yeah, people don't realize this, but the long-term data, people tend to think of the correlation of stocks and bonds is negative. And that's because we had this great moderation when the Fed was suppressing interest rates, right? and suppressing economic volatility as well.
Mm.
Uh, but the long-term data is the correlation between stocks and bonds is about 0.17, if my memory serves. So it's actually positive, and it can happen at exactly the wrong time, which, by the way, happens 50% of the time with gold, we said, right? Roughly 50% of the time when the market's down, gold is down. But 2022, we had stocks down double digits in the US and bonds down double digits in the US. And that's happened, I think, three or four other times in history. So it doesn't always work that way, which
Okay,
is
so
why I
I,
like shorter
so,
term bonds as the hedge against inflation.
so let's say that somebody builds a portfolio of equity, and let's say that, they've got that, let's just say it's 100 million, $200 million, $500 million portfolio. So let's say they can only trade in ETFs. Let's say they're in Thailand, as an example. They're not going to go sign up at a fund management company in America, as an example. And they have what they want for their equity exposure, whether that's US, whether that's global. Let's just say they have the VT fund that owns every stock in the world.
Hmm.
So, they've got their equity exposure, and it's as low as you can get the the risk on that. You're still going to be exposed to market risk with that. Market collapses, it's going to collapse. But from a diversification perspective, within equity, you kind of own every stock. So let's just start from that point. Super
Right.
simple. And now the person's saying, okay, I want to reduce the risk of my portfolio. And that means I want to allocate somewhere between, 5 and $20 million out of let's just take 100 million just to keep it simple. I want to allocate $2 to $10 million into something that's going to, help me to reduce the overall volatility of this portfolio. What would they add?
Yeah. So the first and the easiest way for people, simplest, just go buy a short-term bond fund, say a Vanguard short-term ETF, something like 2 years or something. So you have very little duration risk, very little inflation risk. Uh, and that would be one way to do it. Uh, if inflation does pick up and that's what you're concerned about, you're fine. I don't think there's much risk on the reinvestment risk side because of all of the printing of money around the globe by by governments. Uh, it's certainly possible rates could go down, but maybe they go down to 2.5. You have to remember central banks in the world are targeting inflation of 2. They don't want to see it less than that. Historically, treasury bills have yielded 50, 60, 70 basis points above that. So let's call it 270 for where you would expect the T-bill would be in that world. So you're at, 475 to 5 today. So the most it likely would go down unless you're in a severe crisis, like a financial, is 2%. But if you get high inflation, it could easily go back like it did in the 70s into double digits. So I think the risk is much higher that they go up, and especially with budget deficit problems around the globe. Uh,
So
so that would be one thing.
and,
But
and just to highlight for a second for people that may not completely understand it, really short-term bond fund really is getting pretty close to cash,
right.
right? So, the simplest way someone could say is I have $100 million and I have 10 million or 5 million in cash and 95 in equities. Well, you are in theory diversifying in that case, but
Yeah.
here you're going to get a little bit of return and the like. So what would be your next step?
Yeah, what I think is a superior overall way of doing things is to hyper diversify the risks. So you could add something like reinsurance. So the reinsurance fund today that I'm invested
Is
in
it an
actually has,
ETF? Just so,
unfortunately, it's not an ETF.
yeah.
I don't even know if it's available to foreign investors, but it's Stone Ridge's reinsurance fund. A symbol is SRRIX. The expected return this year was about 23%, and I would guess the expected return next year will be similar. the fund is actually up 23% this year.
Mm,
It's just a matter of luck. But it has no correlation to stocks at all, like gold, like a 2 year, right? It does have more downside risk. In a really bad year, it might go down 25, 30%.
yep,
But the expected return is 23. And there's no correlation. And it has a bit of an inflation hedge because part of that 23% is the return on treasury bills they hold until the year is over because they have to hold the reserves in case bad events happen. So if rates go up as they've done, 4 years ago they were earning zero on their cash. Today they're earning 5%, and up
yep.
until a couple of months
So
ago they were getting five and a. So that's one.
which is great, but in my situation, I'm explaining for the listeners is that they can't buy they got to be in a relatively large and liquid ETF. Let me ask you a question about the short-term bond fund. Is there any reason to hold a TIPS fund if you have a short-term bond fund?
Yeah, because if you have the tips, you can lock in the long-term rate if you think that's attractive. When it was negative, I wouldn't have done it. Today, you're up around 2% or so, and I think that's a reasonable one. I remember in the early 2000s, it was at 4%, and my entire tax advantage portfolio was all in tips. I thought it was the buy of the century, and it did turn out to be that way. 4% real return risk free. To me, that's far better than equities, especially today when the expected real return, probably isn't 4%, at least
And
for US
if
stocks.
we think about it from a 20, 30-year horizon, we're talking long-term horizon. Someone doesn't want to be in and out of these different things. They're happy with their VT fund, as an example. Should
Mhm.
they be adding the short-term bond ETF and a TIPS ETF? How should they think about the
Yeah.
diversifying
Well,
benefit?
if it's tax advantage money, you probably want to own tips because the real yields, I think, are attractive again. Not super attractive, but quite reasonable. And you can lock in that real yield. If you're short term, you have that reinvestment risk showing up,
Mm.
but you eliminate the inflation risk. With tips, you have no reinvestment risk because you could buy a longer term tip and lock that real rate in. So that's a big, if you owned a short-term tip for the 10 years before 2022, I mean, you were earning negative real returns or
Mm.
zero. All right. And, so
And
then it might have been better to own the shorter term bond fund, but you weren't getting anything either there.
yeah, I mean,
Right.
neither of these instruments are going to provide a huge return like equity. Really, I would say the person that's got that $100 million is really putting it in there for the diversification
Yeah.
benefits. And
Yeah. The
so, if we looked at the
downside
short-term bond
protection.
fund and we looked at the TIPS ETF, which one do you think would have a better reduction in volatility over a 20, 30-year period?
Well, the volatility will be lower in the short-term bond fund because you don't have the risk of real rates moving. But
Hmm.
that shouldn't concern you. If you like the 2 year current real yield on tips, all you have to do is hold it to maturity. What do you care what the volatility is in the interim? It's irrelevant. You're going to get a guarantee of a 2% real return plus whatever inflation is. So that volatility shouldn't matter. Right? It's silly to even think about it that way.
Okay.
Right?
And last question is, we've got these two instruments that we're talking about as potential risk reducers for this, long-term $100 million in equity. Is there anything else that you would add? I know in the research that you referenced in the chapter, you talked about Pim Van Fleet's research about gold, and he talks in his research about getting low risk, building a portfolio of low risk stocks. Does
You
that
can
make sense?
yeah, you can I'm not a big fan of that strategy. And because if you own low volatility stocks, okay, well, let me say it this way. there's a low volatility stocks on a risk adjusted basis have outperformed high volatility stocks, which is a violation of the capital asset pricing model. That's big anomaly, which is why the capital asset pricing model is wrong. And everybody knew it like immediately when the cap M came out, but it's a nice theory, allows you to help you think about how markets work, but it's just not true. But if you have a low vol fund with a market beta of zero point 0.8, you sort of have 80% exposure to the market. If the market goes up 10%, you're going to get 8 likely. And if it goes down 10%, you'll only lose 8. And low volatility strategies have only worked and added higher returns when they were in the value regime. So they were cheap and low beta. And today, because of the popularity of these strategies, it's kind of neutral. So there's no premium. So why own them? Now, they actually got so popular, they became growth stocks. And then that low volatility performed very poorly. The most important thing for investors is they should screen out the high volatility stocks out of their portfolio. You do not want to own them, but the average retail investor loves them because they look like lottery tickets and they hope to hit the lottery. But the average return is god awful. But let me add this. I think if you can accept the fact that you will bear some downside risk, okay, I would much rather own real assets than gold because they have a expected real return. So, for example, real estate over the long term, real asset prices go up because part of the cost is land and buildings, construction costs, and real estate will act as a good long-term hedge. And remember, gold only works as a long-term hedge, right? And real estate has basically provided similar returns to the equity market, but might be a better inflation hedge from that perspective. The other asset, which people I think can buy, certainly I know are available in private markets, but they may be available in public, are infrastructure.
Yep.
Because
we have infrastructure ETFs and the like.
yeah, so they, for example, own toll roads and water and things that when prices go up, those things, raise their prices with the inflation rate, and it can act as a hedge that way as well. So I'd rather own something that has a real expected return rather than something with no real expect. But you should probably always have a sufficient amount of the really safest, most liquid, like treasuries or tips, so you can rebalance in a bear market, right? The other assets may be more difficult because they're going down maybe at the same time.
And you mentioned real estate. The problem that we face with real estate is every time you go to think, oh, I'm going to invest in real estate, all you find is REITs. And then you're all of a sudden, there's a rental income, and it's like, as opposed to, let's just say, the most simplest situation of this man or woman who has $100 million is that, well, take $10 million and buy a piece of property in the city that you like and, own a piece of land, build a house, something like that. Would that be the diversification benefit?
Nope, that's really the wrong thing unless you're an expert in real estate. And they'll make the mistake of confusing the familiar with the safe. Oh, I know that building. I know that area. It's like owning one stock. It's got a unique, undiversified risk of that location, that region. Maybe it's exposed to some industry, certainly exposed to one country, and it's exposed to one type of real estate, where if you own a broad real estate fund, you own hotels and warehouses and data centers and all kinds of, commercial real estate, residential real estate. So that's the way I would prefer to own it, in a very broad, lower cost vehicle. If you're using public, then Vanguard's fund or Dimensional's fund would be very good choices.
And are these REITs, or what are they owning? Is it just a bunch of
Vanguard owns an index of real estate that excludes mortgage REITs. I think they also exclude prison REITs. So it owns hotels and warehouses and data centers and apartment buildings and all kinds of stuff. So you're highly diversified, and at least the U.S. fund is U.S. You can own international REITs as well. I'm sure that they're available.
Mm, mm. Interesting. Well, the real estate one is a challenge because every time I see a large liquid REIT, I correlate it to the to the market, and I find a very high correlation. And then I
Yeah,
ask
it's
myself,
true.
and then to make matters even worse is that what many of these REIT funds, let's take an ETF as an example, what they own is listed REITs, which are already in the index. So
Yeah.
I'm just carving out a sector and doubling my exposure to that sector.
But the correlations aren't perfect. You're still getting a benefit and you're getting an expected real return. And remember that the correlation with stocks, you may hold like you're getting down markets like maybe 2022, both stocks and REITs went down, or '08, they
Mm.
certainly both went down, right? But over 10-year periods, it may be very different. And remember, gold is not a good inflation hedge, even at 10 years. But I bet if you looked, I haven't looked, but I bet the correlation with inflation and real estate is probably higher. And okay, certainly over long horizons, real estate would be a reasonable inflation hedge. And that's where gold. So would you rather own something with a real expected return of zero or one with a real expected return, maybe in the 4% or something like that range?
So
Maybe
let's
higher today because REIT prices were so distressed.
let's then wrap this up by going back to this person. They're not highly sophisticated, but they want something super simple. They got $100 million they can invest in ETFs. They've got that 100 million and they've got a 30-year time horizon. They're not short term and they don't want to buy and sell. They want to set it and forget it to some extent. They're 100% exposed to equity through, let's say, the VT fund. So they own every stock in the world. They're not interested in doing a lot of different stuff in that. That's okay for them. They're thinking of, I don't know, 5 or 10% of their portfolio going into something. We've talked about short-term bond funds. We talked about TIP ETF. We've talked about low volatility stocks, and we've talked about real estate. We talked about real estate and going out and buying a piece of land versus real estate investment trusts and other types of funds. And we've talked about infrastructure funds. Okay, now they've heard that discussion and they're going to say, okay, so what would be the one thing that would be the best for me over a 30-year period to add 5 or 10% to this portfolio to reduce risk of volatility a bit? What would you say?
I would say you start with tips, and that should be your first 5 or 10%. That should be mandatory in the portfolio, if you
Yeah.
will. And then you could look at adding some of these other assets. And if you have access to private markets, which I know higher net worth individuals probably have, most places in the world, you could own private real estate, private credit, and the cost of investing in these types of vehicles is coming down. It's come down dramatically in the US. Or I never would have invested in private credit 10 years ago. Now 10% of my portfolio is in private credit and 10% of my portfolio is in private real estate, which is much more tax efficient in the US than REITs are.
So, what a comprehensive discussion about this, starting with gold and then going through and realizing, okay, it's not all it's cracked up to be, and therefore there are other alternatives. We've been through different alternatives. Excellent discussion. So, I appreciate that, Larry, and I'm really looking forward to the next chapter, which is chapter 20. And you titled it A Higher Intelligence. And I just want to read the quote because it's such a great one by Victor Hugo that says, there is one thing stronger than all the armies of the world, and that is an idea whose time has come. And I guess since Trump just won the election, maybe that was the idea whose time has just come. So excellent. And for those of you that want to continue to follow the discussion with Larry, find him on Twitter at Larry Swedroe and also on LinkedIn. This is your worst podcast host, Andrew Stotz, saying, I'll see you on the upside.